Unless you've been living under a rock, you've heard lenders and real estate agents rush to social media. You've heard all the news talking about this new LLPAs, or maybe you heard them talking about how good credit and more money costs you more, and they're screwing over all the people with good credit and more money. I'm going to dive into all this, what it really means, and how it affects you personally next. What's up, guys? Jeremy Kane, living in the Denver suburbs, eXp Realty here, helping you understand what is going on in the real estate market, keeping you up to date of all things Denver. I am a real estate agent, so if you are interested in connecting or you need something from me, please reach out. My phone number is right here, and I look forward to serving you however I can. All right, so let's dive into this new LLPA kind of business. What just happened? We've heard all the news, we've heard all the headlines, we've seen all the memes. So what really just happened is the Biden administration, along with all of the powers that be at FHFA in the conventional loan space, just made it a little bit more expensive for people with good credit and more money to get a loan, and made it a little less expensive for those with low down payments and lower credit. This does not mean that it's now cheaper to get a loan with bad credit and low down payment. It just means that it got cheaper for those people in that class, and it got a little more expensive for the people in the higher class, the excellent credit kind of range and the better down payment. And so as we kind of step back and look at this, there's a lot of stuff going on, and the honest truth is, what the administration and the powers that be didn't realize is that all of these adjustments, still it is a better product for those with low down payment and low credit scores to go FHA. In fact, FHA recently made it cheaper to get an FHA loan because they lowered the mortgage insurance premium. So with all this said, it does help them out a little bit if they are getting these conventional loans with a less than 20% down payment, and they have a little bit lower score. It just made that a little cheaper, but still the best product for that client is most likely going to be the FHA loan, not to mention the VA loan, which is the best product pretty much across the board according to most mortgage lenders, because the VA loan and the ability to get the loan without mortgage insurance, no money down, etc., has always been a great product out there. So the honest truth is, this helped a population that probably won't even use the help anyways, and it did make it a little more expensive for those in better credit scenarios with more down payment, not 20%, but below 20%, but good credit. It made it a little more expensive for those people. So as you can see here, the new versus old purchase prices with the LLPAs. As you can see in the middle, kind of the red cross part of the diagram, it's not saying that these people are getting 0.75% higher interest rate. This is just the adjustment to the pricing for the loan. Essentially, what this shakes out to be is if on April 1st you close the transaction, you are going to have to pay the same amount of closing costs on May 1st that you did on April 1st, and your mortgage payment is going to be about $40 more expensive. So it just made the cost of the loan get more to get that par rate, so to speak. So that's all this pricing sheet means. It's kind of confusing because, as you can see across the top, we talk a lot about down payment and 5 and 10 and 15%. These are loan to value numbers, so it's the inverse of that number. But at the end of the day, this is just the pricing adjustments for each category in each column and row, as you can see. So that's an extremely confusing graph that I'm sure you've seen a few times, but that is essentially, the positives. Red means it got more expensive, green means it got a little better. So take that for what it's worth. After, all this news came out, then you heard people start talking about hacks. One hack that I heard being tossed around was to recast. This is something that made a lot of sense, but when my good friend Nicole Ruth and I actually broke down the numbers, the hack which was being reported, was say, okay, well, why don't you just put down 5% instead of 15%, and you can save on the pricing, and then just recast after one payment. Well, the problem with that is if you have 5% down versus 15% down, your mortgage insurance is higher. And when you recast, it's not a refinance, so it's only a $350 fee in most cases. And what that does is take a lump sum and put it towards your loan, and then it recasts or re-amortizes the payments so that you get a lower payment. The problem is when you recast, you do not reset mortgage insurance based on the new loan to value. So you would still have that higher mortgage insurance, which we calculated to be a little over $100, $140 to save $40 a month, which is the penalty. In the very worst cases on a $500,000 loan, you're seeing about a $40 a month difference in pricing with the new, adjustments. So that hack was kind of out the window. I've heard people say, everyone's going to go FHA. I still don't think that's the case because FHA, although they did lower the mortgage insurance, definitely that still is there. And with FHA, that mortgage insurance stays on for the life of the loan. So you have to refinance to pull that off. And refinancing usually costs between $5,000 and $10,000. Whether it's, taken from the equity or you actually bring it to the table is another story, but it does cost money no matter what. So the recast route doesn't work. FHA, more FHA, maybe, but I think that more people were already going to FHA because the rates were higher. Overall, the FHA rate is always a little bit lower than conventional rate. So it's a better product and it costs less and it helps people with affordability anyways, as it was before and as it still stands. FHA is a better and cheaper product for those people in the lower credit and low down payment range. So I mentioned this a little bit before, and I've run some numbers, whether were the most severely affected is about 1/8 of a point. And so that's, if you were at a 6.5 interest rate, now you're at a 6.75 interest rate. So just 1/8 of a point, which I get it, money's money. It usually costs about $40 on average. I've run it, from 5 to 15%. It's between $38 and $42 a month that it's costing you. But the honest truth is that is the cheapest route if you're in that range, because otherwise you're going to throw away a lot of money on mortgage insurance. Mortgage insurance is the life of the loan, and we already talked about that. So approximately $38 to $42 a month, and there's really no way around this unless you just wait and save 20%, which again, that's going to cost you money too, because you're paying $30,000, $40,000, $50,000 a year in rent. And so if you're making that rent payment, you're throwing away much more than the $40 a month. You're basically throwing away your entire rent payment, $2,000, $3,000 a month in some cases. So unfortunately, for those 10 to 15% down kind of people with good credit, it's just going to cost a little bit more, which seems unfair and doesn't make a whole lot of sense. This helps people who aren't even going to use the conventional product in the first place, because FHA is still cheaper, as I've said several times. And so that's kind of why it's a little confusing. Doesn't make sense. I think it was a good intention to try and get people that maybe weren't, able to afford homeownership. But the truth is, $40 is not really a swing when it comes to making someone approvable versus not approvable. So that's kind of the problem that we have at this point. And so after we wash this all away, and I've said a lot of numbers, and if you're still with me, you're probably really confused. What does this mean for you? As I always say, the best time to purchase a home depends on your situation and your life and what is going on. The numbers are going to be the numbers, the $40 a month, the market this, the market that. It doesn't really matter. The best time is when it's the best time for you, and each individual situation is different. So if you're interested, please book a call with me in the link below. I'll post the calendar link. I'd love to talk to you about your situation, whether you think you can buy next month or in 5 years. I would love to be a part of that conversation and help you do it, because I believe in home ownership, and I can help you obviously find the best lender to get you in the best product so that I can find you the best house. And that's what I love to do. I have a goal to get people into home ownership, as it changed my life completely. Whether you're 19 or you're 40, 60, whatever you are, I would love to help you and have that conversation, because it honestly changes lives. I was literally just watching Instagram stories not too long ago. Someone said she helped someone sell their house for $1.1 million 3.5 years ago, and today it sold for $1.7 million just 3.5 years later. So that's $600,000 in equity that just was built from home ownership, owning the home. I think she said they fixed 2 light fixtures and painted some walls and made $600,000 in 3.5 years, and they got to live in the house. Obviously, those are big numbers. I understand that not everyone's ready to buy a $1.1 million home, but the bottom line is you get in and you gain equity as you go. You have shelter, you have a place to live, and that's why homeownership wins the day most days. Thanks so much for tuning in. Jeremy Kane, living in the Denver suburbs, and eXp Realty. Happy to serve you. Look forward to talking to you soon. Have a good one. Bye-bye.